Okay, welcome back. In this section, we're going to talk about the 7 deadly sins of trading. Now, I know that the title is a little bit humorous, but truly, these are the 7 most common mistakes that traders make. And the reason why I call them deadly sins is because if you commit them often enough, they will kill your account. So, I do want to leave the humor behind and get into a very serious subject. Traders oftentimes don't know when they're making mistakes. And if we can at least understand what the most common mistakes are, we have a better shot at understanding and getting rid of them. Remember, I talked about The Apprentice and Donald Trump. His major objective is to make sure that his managers, employees, and other key people understand when they do make a mistake, they actually have the ability to see what that mistake is. And as a trader, if you don't see your mistakes, if you don't understand that your actions are really very critical and deadly mistakes, then you're not going to have an incentive to get rid of them. So let's talk about some actions that traders commonly do that we need to get out of our life completely. The first one, getting in too late because of hesitation. This is, some people feel like they're waiting for more and more confirmation. Some people feel like they're simply being more conservative. Bottom line is, guys, if you're hesitating, then you're not following your system. And what I mean is, the second that you get a signal, you need to either place your order or you need to have an order placed already so that your position automatically gets put in. Hesitating is a very serious error. Also, getting in too soon. If you get in too soon, what it simply means is that you don't really trust that your system is right. It can also be a sign that you're getting a little bit greedy, thinking that you can get a better position. Again, it's a mistake that you've got to understand it's a mistake and develop the habits that help you to stop doing it. The next two are probably the most serious mistakes that you can make. The first is calculating a stop, but then ignoring it. In other words, you haven't put it into the market. It's just what's called a mental stop. And some professional traders use it, and others don't. In fact, some professional traders always have a stop in the market because they know that they have a tendency to ignore the stop. Then they wind up in a trade hoping it will come back to break even. My policy is, if I find that I am talking about a position as if it needs to come back to break even, or I'll exit when it gets to break even, I will exit immediately because I'm not in the right frame of mind. We need to be in the frame of mind where we're following our system and we're not focused on what the market's doing. Remember, we cannot control what the market does. We can only control what we do. Not calculating the stop at all is the most deadly mistake of them all. If you don't calculate the stop before you get in, you will take on more risk. It's a well-documented fact. There are study after study that show that the average person will take more risk in their investments than go in the other direction and taking too little risk. So you've got to calculate the stop. You have to understand what the risks are. Another mistake is watching a winner turn into a loss without taking any profit. Now, true enough, you may get a position that moves just a little bit, maybe 5, 6, 7 pips in your favor, and then it turns around. And really, that's too small of a move for us to get in on. But I'm talking about a winner that is 20, 25, 30, 35 pips moving in your favor, and you haven't taken any of the position off. Remember, the key to momentum trading is taking a chunk of your position off and then letting a small portion ride.